Hello, world. Welcome to the 39.6 Facebook Live Finance Show. Today is Thursday, August 27. Today is episode number 53, Investing in a Syndication During COVID. Thank you, everybody, for coming. This is a show that teaches you how to make your money work for you so you don't have to work for your money. We talk about investing, taxes, real estate, syndications, Airbnb, even the car you drive. If anybody's out there and you can hear me and you can see me, please give me a shout out so I know the audio and the video are working. So great to see people here at this late evening hour. All right. And today's question, it comes from Drew, and it's a question posted in the Facebook group, the 39.6 community. Please join if you haven't already. We have about 430 people. This question's from a couple of weeks ago, and I'm just catching up. He says, could you discuss the outlook of owning real estate and investing in syndicates given the financial problems due to COVID? I have heard that both some residential and commercial renters are not paying rent due to COVID. Should people wait on these types of investments? Similarly, what is the outlook on the stock market in general? How are the Dow Jones and the S&P 500 doing so well during the pandemic? Would you change any of your asset allocations? Less real estate, more stocks, etc. Okay, this is an excellent multi-faceted question. So first of all, we had a separate episode. It feels like forever ago, but I think it was just about a week and a half ago. And that was regarding pause distributions and negative K1s. Pause distributions, episode 41. That's when it was. And we talked about how syndications right now, many are not distributing cash. Some of them are kind of just bulking it up in case, or some are cash flow less, so they are distributing less. But I discussed at length the eviction moratoriums that are going on throughout the country in various locations. And these rules are changing on a day-by-day basis. But interestingly, there are still cities that are doing well and some that have actually done better during COVID, or they're, doing better during COVID versus prior to COVID, for whatever reasons they may be and whatever market forces are in place in those metropolitan areas. Okay, so we had discussed our current deal in Atlanta, MSA. Atlanta has done better during COVID than it did before. So there are locations that are doing better, but you should certainly take caution in investing in any type of syndication right now, because with eviction moratoriums, if they are in place in the locations where a deal is, it is hard to know what might be going on 2, 4, 6 months from now. Okay, and it is very possible that the percentage of paying tenants will decrease and decrease, because if somebody's unable to make the rent for a given month and they know they can't be evicted, they're not going to be paying the rent the next month, right? And they're going to continue not paying the rent unless they have some reason to do so, which will often be eviction. So that percentage of non-paying tenants can get quite large and make the cash flow and your debt service coverage ratio for any given month quite thin, or even dip below 1.0, which means you are cash flow negative on that month. So you have to be cautious, but certainly there are situations where the numbers work and it's something that is a very reasonable thing to do. Okay, but do your due diligence. Now, similarly, what is the outlook on the stock market in general? Wow, I don't have a crystal ball. Or it is quite cloudy, is what many people will say. I have no idea what the outlook of the stock market is. I don't really care so much. I don't pay attention too much to it, although it's hard to completely ignore the stock market, especially when you just pay attention to financial things. Part of the question here is, how are the Dow Jones and S&P 500 doing so well during the pandemic? Yeah, it's baffling how valuations are as high as they are. There have been a lot of things going on. Interest rates keep getting pushed lower and lower and lower. The Fed, all of these things that people in higher up positions do to try to kind of juice the economy. When you decrease interest rates, it increases people's borrowing, right? People say, oh, I want to refinance, I want to buy a house. Home sales in July were like record highs, and there's like no inventory right now for homes. I was searching our area, the Park Cities in Dallas, for 4-bedroom houses. I think there were 8 houses with 4 bedrooms that are currently on the market. There's just no inventory. Everything is quite thin right now. And I think only 2 of them were under $1.5 million. Just very, very, very limited inventory. But yeah, super low interest rates, people getting 30-year mortgages under 3%, that does juice the economy. But what also happens is that the nominal yield of bonds gets lower and lower and lower. And so people divert their money toward equities because they're trying to get a better return, because the nominal yield, which is the interest that the bond pays, is so low. And so it can shift money from the bond side to the stock side and increase valuations of stocks, such that we're getting to PE ratios, or price to earnings ratios, of the S&P 500 above 30. Just mind-blowingly high ratios. I mean, what that basically means is that for every $30 you pay for a share of a company, you're getting $1 of earnings per year. You're getting like a 3% return in earnings. That is a very low percentage to take as earnings. But when nominal bond yields are like less than 1%, and money market accounts are paying far under 1%, and even high yield savings are down to, I think Ally was at 0.8% recently. 3% is potentially attractive compared to those numbers. So they're running out of levers. I mean, they keep putting money into the system, decreasing interest rates. There's only so much that can be done to keep juicing the economy. But these valuations are super high. Earnings have not necessarily gone up in parallel with the valuations, which is why the PE ratios are just incredible. So, yeah, I don't have, honestly, a very favorable outlook on the stock market in the medium term and the short term. The long term, it'll probably be the same as it has been over the long term historically. But, I don't know. Japan has had a very rough multiple decades with basically flat over the past 30 years. So could that happen here? I don't know. Why not? Sure, it could. Probably won't. I don't know. That's not my area of expertise, nor something that I wish to really care too much about, because I can't really control it. So with that being said, he says, then what would you change any of your asset allocations? And so a lot of the reason why I don't really care that much about the stock market, one, I can't control the stock market, right? It's not within my locus of control. So it just is, and you can choose how you locate your assets and how you invest, but you can't control the returns. As opposed to owning your own business or investing in like a syndication in real estate, where you actually can force appreciation. That's why I spend so much more time focusing on these types of assets, because I actually can do something about it. Now, it's not that I don't have publicly traded assets like the S&P 500 or the total US stock market or total international stock market. I do. I have these in my retirement accounts, my wife's retirement accounts. We have a cash balance pension. And we have a little bit of publicly traded equities in our taxable account. And I use that for tax loss harvesting and just another buffer of liquidity. But our asset allocation overall, including all of our assets, is more than 50%. In real estate, it's probably around 60%. It really depends how you add it all up. But yeah, it's probably like 60% or so. And then our total amount of equities is probably around like 30%. And the rest of it is cash and bonds. So I don't really care because of how the stock market is doing that much, because it's really a very minority position in our total portfolio, and I can't do anything about it. I just can't. I can rebalance, but we keep buying within those accounts based on what our investment policy is. So we just let it be those dollars, with the exception of the money in the taxable account, which we really don't liquidate that. That's really our liquidity buffer. We also use that for donating appreciated shares to our donor advised fund. But yeah, it's such a overall not substantial portion of our portfolio that even if it were to take a 30% dip like it did earlier this year, the impact on our portfolio was like 10%. Yeah, it didn't look that awesome watching it happen, but 10% of our portfolio is something that we can replace with a matter of months in terms of putting more money in. So what really happened during the crash from like March, April, May is our net worth basically just kind of stayed flat, as opposed to just going up every month like it used to, because we just throw so much money into our investments every single month that in those months we were just kind of replacing the losses, and then it started to go up substantially after it has been recovering. But I know there are people out there who, they put money in like April, and they've had enormous returns and they're riding these huge waves on the equities. But we know that over time, that because of the volatility, the compound annual growth rate of the S&P 500 is nominally going to be between 7 to 10%. Right? Even if you have a 40% year, it only takes one negative 50% year to lose years of earnings. Right? So if I can get that same compound annual growth rate without the volatility, but just continue kind of on a steady course, that's just a much better risk-adjusted return to us. So that's why our equity allocation is relatively small. We have some bonds in there, and then we have our real estate, which is cash flowing with growth. So on a risk-adjusted return basis and overall return basis, we're very happy with it. Although we're probably not going to have years where we make 50%. Okay, and people who have all equities, they certainly could have that, especially if you have things like micro cap, small cap companies, emerging markets. These can be very high return in individual years, but over like a decade period, that volatility evens out to closer returns to 7 to 10%, maybe up to 12% with some of these smaller company allocations or emerging markets. And depending if you look at it based on the nominal return or the inflation adjusted real return. Okay, so these were a number of questions, and I think I covered them all. Another day, I'll kind of dive more into what our portfolio looks like and how we go about managing what goes where. But it's really not that complicated. Our public securities are in our retirement accounts, and our taxable assets are mostly real estate because it's super, super, super tax efficient. All right, that is it for today. Episode number 53. Again, brought to you by the Medicine, Marriage, and Money podcast, coming at you September 14th, maybe the 17th, but I think it's the 14th. And again, this is for purely entertainment purposes, not to be misconstrued as legal, financial, tax, or any other advice. Please contact your professionals for all such matters. And we will see you tomorrow for episode number 54. Have a good one.